Welcome to this course on marginal profitability analysis. You'll learn how marginal profitability analysis can help you make better business decisions. If nothing else, after listening to me talk for an hour and taking a test, you'll be a little closer to meeting your continuing education requirements. We'll start by defining marginal costs and marginal profitability. Once you have those basics down, we can then begin to look at how to calculate marginal profitability. Many of you may be familiar with traditional full absorption costing or activity-based costing, so I'll compare them to marginal profitability so you know the pros and cons of each method and when each is appropriate. Finally, we'll get very practical with some examples of making decisions with marginal profitability analysis. I'll show you how marginal profitability analysis can help you determine optimal production volumes and which products to promote. We'll look at how to calculate the change in profitability from a price increase or a price decrease. Marginal profitability analysis is very useful for setting pricing, but not the only tool you should use, so I'll explain how to use it for setting pricing. Before we dive into the materials, I wanted to tell you a little bit about me and my background with marginal profitability. I'm currently the founder of CFO Perspective, which provides financial consulting and education to small business owners. I was previously the CFO of a couple banks and a community health clinic system. Yes, I have a CPA license, and so I know what it's like packing in these CPE courses to meet renewal requirements. Sample workbooks, templates, and other items are included with this course and posted in the course materials of the CPE course provider. I also listed my website because some items like the price analysis template we'll look at are also on the free resources page of my company's website. I wanted to give you that very short bio to provide context of how I've used marginal profitability analysis over the past 20 years. One way that I've used it the most is setting pricing. I would model the change in profits caused by changes in pricing. When I worked at larger companies, this was the analysis I presented to the pricing committee to inform decisions. Sometimes we would model different options during the meeting to arrive at a price that made us more competitive in the market without sacrificing large amounts of profit. Closely related to product pricing is product design. My staff and I have modeled changes to product design to see how the changes increased or decreased profitability. Product design is often an iterative process of changing the current product or the initial design of a new product until a new product design is found that will increase profits. Marginal analysis has determined whether a new location or division will contribute to the company's profits or how long it will take before it has grown to the point where it provides marginal profits. Break-even analysis is very useful when working with others to determine if the volume needed to achieve marginal profitability is reasonable or not. Marginal profitability analysis has also informed the potential profit implications of closing a location or a division. I've modeled data tables with multiple scenarios of how many customers we would lose and varying costs to replace those customers and the funds they provide to the bank. Marginal profitability has also provided insights into the relative profitability that each product provides to the company. Managers may feel helpless or resent allocation of fixed costs to their products and divisions. It's a tricky conversation when an accountant like me, who's seen as parasitic overhead, presents reports to a product manager that says whether their products have profits that are high enough to cover their direct costs plus my salary. Fixed cost and overhead cost allocations can obscure performance results. Marginal analysis may not tell the whole story on profitability, but it does provide information on past performance to inform decisions on what to do with products. Many banks also calculate profitability at the customer level. I wrote a system to do this and a program to model how new products would change the customer profitability or the profitability of new customers. This modeling used marginal profitability analysis. These are some of the practical uses of marginal profitability analysis. I'll be going into some of these in the last half of the course, but before we can start playing with numbers, we need to understand some basics, which I'll cover next. We'll first start with some definitions of terms I'll be using throughout this course. These concepts will build towards explaining what marginal costs and marginal profits are. To understand product and marginal profitability analysis, you need to understand different ways costs can be categorized. The first category is direct versus indirect costs. I'll then explain fully loaded costs, which assigns overhead to products. Next, I'll cover fixed, variable, and step fixed costs. Once you understand all these categories, I'll then explain marginal costs and how that category differs from the other categories. Direct costs are costs that can be traced to a specific service or production of a specific product. Examples include material costs and salaries of people on the production line or working directly with clients. I added the last example of staff working with clients to emphasize that product profitability isn't just for manufacturing companies. Many of the examples we may have learned of in college or seen elsewhere are often in the context of a manufacturing company. The categories we will discuss can also be used for service industries, which comprise the bulk of the U.S. economy. In this course, I'll use the term product profitability for both physical products and for intangible services. For both, the goal of product profitability is to break down the company's total revenues to see how much profit each product is earning. Later in this course, I'll talk about the difference between traditional product profitability, activity-based costing, and marginal profitability analysis. Direct costs don't present much of a problem for any of these analyses because costs are highly relevant to the product. Also, many of these costing categories don't just apply to product profitability. Most of my career has been in banking, and I've used categories that I'll be discussing to do profitability at the organizational level, at the department level, for products, for customers, and even for individual accounts of customers. So you can slice and dice profitability analysis so many ways, and the categories I discussed just help inform different ways of viewing profitability. For this course, we'll just focus on marginal profitability. Indirect costs are costs that can't be traced to a specific service or production of a specific product. Examples include rent, especially for administrative offices and executive salaries. We can go further in talking about direct versus indirect versus overhead costs, but we'll just stop here in breaking costs into direct and indirect costs. The strength of classifying costs as direct versus indirect is identifying how well costs can be assigned to cost units. It's useful for identifying the correlation of costs to cost units, but is weaker at the correlation of those costs at varying volumes, which fixed and variable costing addresses. I'll talk about that in a couple slides. Fully loaded costs refer to when we allocate both direct and indirect costs to cost units. These cost units might be products or departments, divisions, or even customers, like I talked about earlier. Let's talk about this in the context of product profitability. We can easily assign revenues to products. Assigning direct costs to products is no problem. Indirect costs present major challenges for profitability analysis. But how do we assign these indirect costs to products? Sometimes that allocation can be challenged as arbitrary, especially to products or departments that feel like they receive an unfair share of those costs. I mean, let's face it again, finance and accounting staff can be seen as the blood-sucking overhead expense leeches on the cash lifeblood provided by the sales or production processes. We compound the animosity when we allocate our salaries to those departments or product managers and remind them that they must cover our costs, the allocation of which are perceived by those managers as arbitrary and unfair. I'll defer my thoughts on whether we're blood-sucking leeches, but those managers have a point about whether indirect and indirect cost allocations are useful or not, or whether they're arbitrary or not. Here's our struggle as accountants or analysts, though. We know that all revenues must cover all the costs. If we don't allocate indirect costs and overhead to each product, we're concerned that we'll underestimate or understate the cost of each product that each product must cover. However, we know how arbitrary the allocation driver is. It may be a percent of revenues, it may be direct costs, direct salaries, or some other number that we made up. We know because we were in the meeting where we debated and decided on that driver and told everyone that's our story and we're sticking to it. We know it's tough to defend, but we are driven to find some way to allocate all costs and profits to products or departments. Our greatest fear is that if we don't allocate all the costs, products will be underpriced so they cover just their direct costs but aren't covering those indirect and overhead costs. Then the company as a whole would lose money. In fact, companies have made that mistake, and not just with direct costs, but also making the mistake of just covering their marginal costs and not covering their fixed and overhead costs. Someday, I'll create a CPE course on the politics of profitability analysis. It'll be non-technical, but it'll be very useful for CPA career survival. All right, let's move to another set of classification of costs. This is whether they are fixed, variable, or a hybrid called step fixed. The categorization tells us whether the costs vary with production or not. We'll start with the easiest category, which are fixed costs. These costs don't change with volume. For example, rent or depreciation don't change when your production volumes go up or down across a wide range. Yes, if you greatly increase or decrease in size, you may buy or sell buildings and your depreciation will go up or down. However, those are additions or subtractions of fixed costs and not changes of your existing fixed costs. Variable costs are the other end of the spectrum in this categorization. They change with changes in your sales or production volumes. Classic examples include material costs. Each item you produce uses raw materials. The more you produce, the more your cost of goods. From the examples I used earlier, it's easy to draw the conclusion that direct costs are the same as variable costs and fixed costs are the same as indirect costs. Variable costs can be indirect costs and fixed costs can be direct costs. In this table, I show the 4 possible combinations with examples of each. The rows designate direct or indirect costs. They are intersected by columns of fixed or variable costs. There are examples for every intersection. There are 2 different categorizations that measure 2 different things. Fixed and variable describe changes in costs with changes in volume. Direct and indirect measure whether the cost is caused or driven by sales or production of goods and services. Using terms like direct and indirect or fixed and variable make it sound like costs can fall into one of 2 buckets for each categorization. And the previous table makes it seem like there are 4 discrete options. Actually, all the categorizations we've talked about can be thought about as a spectrum of classification for each cost. For fixed and variable costs, the longer the time frame or the larger your production change we're looking at, the more likely a fixed cost could be considered a variable cost. This concept is going to be very important when we look at marginal costs. This middle grouping of costs have some fixed characteristics and some variable characteristics, and they're called step fixed costs. Over short terms and small production changes, they act like fixed costs and don't change with volume. At some point, the cost greatly increases though. This usually happens when capacity or the life of a fixed cost item has been met and more capacity is needed.